Welcome to Traders Lessons, the trading academy that helps you navigate the complex world of financial markets. In this video, we will discuss trading channels, an important concept in technical analysis. Trading channels are price ranges that help traders identify potential buying and selling opportunities. They consist of two trend lines, one representing the upper boundary and the other representing the lower boundary of the price range. The upper trend line connects the swing highs, while the lower trend line connects the swing lows. When the price reaches the upper trend line, it may signify a potential resistance level, indicating a possible reversal or a slowdown in price movement. Conversely, when the price reaches the lower trend line, it may suggest a potential support level, indicating a possible rebound or a pause in price decline. Traders often rely on trading channels to identify trend continuation or trend reversal patterns. A breakout above the upper trend line may indicate a bullish signal, suggesting a potential uptrend. On the other hand, a breakout below the lower trend line may indicate a bearish signal, suggesting a potential downtrend. However, it's essential to wait for confirmation before making any trading decisions based on trading channels alone. Trading channels can be applied to various timeframes, from intraday trading to long-term investing. It's important to note that trading channels are not foolproof and should be used in conjunction with other analysis techniques. Developing a solid understanding of trading channels can significantly improve your trading skills and increase the probability of successful trades. So, if you're ready to take your trading to the next level, enroll in our Traders Lessons Academy and start mastering trading channels today.